Ladies and gentlemen, good day and welcome to Rossari Biotech Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. And now hand the conference over to Ms. Aisha Shah from CDR India. Thank you, and over to you, Ms. Shah.
Thank you. Good evening, everyone, and thank you for joining us on Rossari Biotech Q4 and FY22 on this conference call. We have with us Mr. Edward Meneses, Promoter and Executive Chairman, Mr. Sunil Chari, Promoter and Managing Director, Mr. Ketan Sablu, Group Chief Financial Officer, and Ms. Mansi Nazar, Chief Financial Officer. We will begin the call with the opening remarks from the management, following which we have the forum open for question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and disclaimer to this effect have been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Edward Meneses to make his opening remarks. Thank you, and over to you, sir.
Sir, we are unable to hear you. May I request you to unmute your line from your side, please?
Thank you, Aisha. Good evening, everyone, and thank you for joining us on our Q4 and FY22 earnings call to discuss the operating and financial performance for the quarter. I hope you all had the opportunity to go through our results presentation, which provides details of our operational and financial performance. I am happy to share that we have delivered an encouraging performance during the year despite macro challenges. Fiscal 2022 was, in fact, a milestone year for us on the business front. We successfully acquired and integrated 3 high-potential companies, Unitop Chemicals Private Limited, Tristar Intermediates Private Limited, and Romax Chemicals Private Limited. In the HPPC segment, with the synergy of polymers and surfactants, we have introduced a novel ingredient that not only enhances cleaning performance, but also provides a value addition to the customer. Then, under our Brazil Rossari banner, we have launched Dr. Nanoxa brand, thus marking our foray into the nanotechnology space. This range of products offer a 30-day antimicrobial and antiviral protection and is based on unique nanotechnology that stays fixed to any surface. Coming to the textile segment, a new range of products have been on polyester chemistry was developed and scaled up at our Dahej site. This will fill a major product gap in our textile portfolio for the sizing market in polyester and cotton fabric. Additionally, the application team at Rossari worked jointly with Unitop to develop a range of products for the spin finish market, which we have already been approved by key global customers. In sync with our DNA to work with green chemistries, Rossari's R&D team has successfully introduced green products in newer segments to reduce high TDS and save energy by designing products that work at lower temperatures. The state-of-the-art sustainable dyeing program for blacks using green chemistry has been successful on knit fabric and is generating good interest from big brands. In our AHN segment, a new range of esters and glycerides have been successfully tested to enhance gut health in poultry and reduce the use of antibiotics and artificial growth promoters. In the pet care space, we have launched exciting new brands based on biosurfactants and green surfactants. Overall, we have received an excellent response from pet parents for this. Our teams are also together developing environmental friendly silicones and next generation preservative ingredients. Using Rossari's Dahej state-of-the-art production facility and Romax technical expertise, a new range of silicone oils with low volatile cyclic compounds were manufactured with a focus on sustainability credentials. The year also saw a joint development exercise between Tristar and Unitop R&D team at Unitop's state-of-the-art pilot plant that led to the development of a next generation of preservative ingredient, which has major potential in the export market. So these are just some of the innovations that were launched over the last fiscal. In addition, our R&D has worked fervently to improve formulation recipes, and the sales teams are focused on higher margin product sales to improve margins across our businesses. As we look ahead, we foresee an array of growth opportunities across all our business segments. We remain well poised to cater to these growth prospects on the back of our diversified product portfolio, strong innovation capabilities, increasing customer base, and agile manufacturing establishments. With this, I would like to conclude my address, and I now hand it over to Mr. Chari for his comments.
Thank you, Edward sir. Good evening and warm namaste to everyone. We have reported a healthy performance during the year, driven by strong momentum in all our business lines. Increased client engagements with new and existing customers across various industries, and steady demand translated to healthy offtake during the year. In addition, demand in the export markets aided sales in the textile specialty chemical division. Even our acquired companies, namely Unitop, Tristar and Romac Chemicals, delivered strong and performed promising growth during the year under review, which assisted our overall performance. The integration of these three acquisitions continues to bring in several promising growth prospects for us. It has enhanced Rossari's technical capacities in our two key chemistries, namely surfactants and silicones, and has also presented strategic cross-selling opportunities across dominant markets. The coming together of related technologies of Unitop, Tristar and Romac, along with Rossari's deep application expertise and fungible manufacturing capabilities has enabled us to introduce several innovations during the year. On the raw materials front, the industry globally continues to witness severe pricing and availability issues in key raw materials. The ongoing geopolitical conflict has further affected the supply chain network. So while the inflationary pressures had an impact on our margin performance during the year, we have been working alongside our customers and have started undertaking price hikes. Coming to the business front, in addition to our new product launches that were covered by Edward G, we have also been seeding new business lines across various industries like water treatment, paper, ceramics, cement, and have been actively working on new product innovations. Thus far, we have seen a strong and favorable response to all our innovations and new launches. Additionally, we are also witnessing robust momentum in Unitop's agrochemicals business, and our emphasis is on further strengthening this segment on a global scale going forward. To summarize, we have reported an encouraging performance in FY22. As we look ahead, we are seeing ample growth opportunities in the domestic market for all our business verticals. Our diversified product portfolio, fungible manufacturing capabilities, and our focus on constant innovation position us well to tap upon these multidimensional growth prospects. Additionally, the stabilization of the RM environment and demand scenario in the country will further support business momentum in the quarters ahead. On this note, I would like now request Ketanji to share his perspectives.
Thank you, Chari sir, and good evening to everyone. We closed the fiscal year 2022 on a positive note. The year saw major operating challenges for Rossari on account of COVID impact, supply chain constraints, again inflation in key input prices, and more recently the geopolitical conflict. Despite these issues, we are encouraged on how Rossari has been able to navigate through these challenges and delivered a healthy performance. On a consolidated basis, our revenue has grown 109%, and on a standalone basis, we grew a solid 55% year on year in FY22. Our key strategy during FY22 was to push sales in Rossari during these volatile times so as to maintain our absolute margins, and also secondly to ensure seamless integration of all the acquisitions. I think on both these fronts we have been quite successful. Our Dahej plant has become fully operational towards FY21, and this additional capacity helped us push higher volumes during the year, leading to stronger revenue growth. Also, the acquisitions happened at the right time and their effective integration helped us navigate successfully during this challenging year. If we see over the last 3 years, that is, if we compare from FY20, we were able to more than double our revenue and increase our EBITDA by almost 75% at a group level. On the balance sheet front, we continue to remain very strong. Even after undertaking organic and inorganic expansions during the year, our balance sheet profile remains very healthy. We continue to be net cash positive, and our net cash stood at about 52 crores at a group level. Our working capital position remains strong in spite of substantial revenue growth. Overall, our working capital cycle continues to be below 60 days, which I think, given the current situation and the way we've grown, I think that's very, very commendable. In line with our company guidelines on dividend policy, we are pleased to share that Board of Directors has recommended a final dividend of rupees 0.5 per share during FY22. So overall, the company's financial position remains healthy. Over a longer term, we will pursue our defined strategic initiatives while always maintaining financial discipline. In a normalized environment, we look forward to delivering a strong and sustainable growth. On this note, I would now request Mansi to take you all through the financials for the year and the quarter, and post that we'll be happy to take Q&A from all of you.
Thank you, Ketan sir. Good evening, everyone. Let me provide you with a brief overview of financial performance for the quarter and year ended March 31st, 2022. During the quarter, we have delivered steady performance driven by improved demand and traction across businesses. On a consolidated basis, revenues came in at 439 crore as against 218 crore in quarter 4 FY21. On standalone basis, we registered an exceptional organic revenue growth of 30% on YOY basis in Q4 FY22. Revenues from HPPC stood at 304 crores, contributing to 69% of revenues, followed by textile business at 110 crore, contributing 25%, and AHN at 25 crore, contributing 6% to total revenue. On the profitability front, EBITDA stood at 52 crores as against 35 crores in Q4 FY21. EBITDA margin stood at 12% as against 16% in Q4 FY21. As indicated, gross profit and margins during the quarter were impacted on account of raw material challenges. PAT during the quarter stood at 24 crores as against 22 crore in Q4 FY21. On a full year basis, our consolidated total revenue from operations in FY22 stood at 1483 crore, up by 109% on YOY basis. On a standalone basis, we marked 55% YOY growth in FY22 owing to strong client wins. Revenue from HPPC stood at 966 crores, contributing to 65% of revenue, followed by textile business at 405 crore, contributing to 27%, and AHN at 112 crore, contributing 8% of total revenue. On the profitability front, EBITDA stood at 183 crore as against 124 crore in FY21. EBITDA margin stood at 12%. Depreciation was higher at 48 crore owing to amortization of fair valuation on account of consolidation of subsidiaries. Interest cost during the year stood at 13 crore. PAT during the year stood at 98 crore as against 80 crore in FY21. From a balance sheet perspective, cash and cash equivalents during the fiscal stood at 52 crore. Net cash flows from operating activities during the year stood healthy at 29 crore. On that note, I come to the end of our opening remarks and would request the moderator to open the forum for operational and strategic clarifications that you may have. Thank you.
Thank you very much. We now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Anshul from Edelweiss. Please go ahead.
Good afternoon. Thank you for this opportunity. I have a couple of questions. First one on the standalone entity. We noticed that there is a slight moderation in the revenue in the fourth quarter. So just want to know which segment led to this moderation, and could you give us the exit run rate of both Unitop and the TriStar for the fourth quarter in terms of revenue and EBITDA?
So, Anshul, quarter 4 is slightly about 2-3% below the last quarter. The growth over last Q4 FY21 is about 30%. I think the overall volumes have been same across all our 3 business segments. This year, this quarter, what we had strategized was to, look at our overall product basket and try to ease out of products where the margins were not really competitive or on the lower side. So that's something we looked at during this quarter. Secondly, your question on Unitop and TriStar. So Unitop this quarter had a revenue of about 124 crores, so 4% growth quarter on quarter. And TriStar was at about 49.5 crores. That's about a 15% growth quarter on quarter.
Anything on the EBITDA number, sir?
EBITDA, usually we don't give out absolute numbers, but in both Unitop and EBITDA and in TriStar, we had healthy EBITDAs. Unitop was around 15% and TriStar was at about 12%. So around about those percentages, which were similar to what they were, or probably slightly higher than what they were in the last quarter.
Thanks. That's really helpful. So just one follow-up. In terms of margin, we have seen that the quarter-on-quarter we have gone to good improvement in the margins of EBITDA, and it gives me a sense that we are able to do the price pass-through. So could you just give us a detail? Was we able to do partially, or there is a more prominent impact which will be coming in the following quarters? And secondly, on the volatility of the raw materials, so how the situation has been in the first quarter of FY23? That's all from my side. Thank you.
So yeah, Anshul, as you rightly said, and I already told you that this quarter we also, apart from pushing in some price increases, we also looked at our product basket, and where we realized that the margins are below or on the lower side, we tried to moderate those sales in this quarter. So that also impacted slight improvement in the gross margins. Some price increases we have started taking from the month of March. We plan to keep up this momentum in this quarter, that's quarter 1. And again, parallelly looking at the basket of products from a margin point of view. And we hope that we'll see a more stable margin profile going forward. So maybe Q2 is when we expect the margins to, look a little more stabilized. On the raw material front, I think we are still, while we are seeing some softening happening on major raw materials, but given the current situation in China, lockdown, geopolitical situation, it's actually a little difficult for us to really guess how the raw material situation is going to pan out going forward. So we are still taking calibrated view on the raw material front, and we hope that the calls that we take on this front prove to be helpful for us. But currently the trend looks towards softening.
Thank you, sir. That's really helpful. Thanks, and all the best for the upcoming quarters. Thank you.
Thank you very much. Participants, you may press star and 1 to ask a question. The next question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Good evening, all, and thanks for taking my question. I got few. First on the HPP3 segment for the Rossari parent, which is ex of acquisition if I look at it. On the standalone basis, the revenue has sharply come down from 190 crores at the peak of Q2 FY22 to close to 126 crore in Q4, while we were anticipating that the new capacity which will unlock the ability to produce more, as well as the seeding in the new industry, would help us to drive a significant growth in the revenue. So what's bothering us in the HPPC segment for the Rossari, and why 35% drop in the revenue from the peak, and in the time when the raw material inflations are significantly high? That means underlying volume decline looks much more steeper. Can you help us explain the HPPC segment for the parent Rossari?
Sanjay ji, namaste. As we had told in the earlier quarters, Q2 was an exceptional quarter, and Q2 sales, if you see also for all the divisions, and if you compare Q2 sales to Q4 sales of all the divisions, you find much lesser. But if you compare the HPPC Q4 with HPPC Q4 last year, you will still find growth in HPPC. So what I would request is to consider Q2 as exceptional, because pipelines were empty, which we already told in Q2 earnings call and even Q3 earnings call, and we had to push in. And also Q2 was the height for supply chain logistic mismatch in the system, and we had a lot of customers coming to us who were buying small quantities from us, but they did not get material from our competitors, and we were able to supply. So this year, in spite of we growing 50% in top line, on a consolidated basis, we have grown 50% in EBITDA from maybe 120 to 180 crores. I'm saying approximate figures, and still being debt free, making this integration successful. We are very happy with what we have done in HPPC also in the Q4 quarter.
No, I completely agree, Sunil sir. I'm not taking out any of your effort on the business side. Just wanted to understand, even from Q3 to Q2, we have fallen from 146 crore to 126 crore. So the decline continues. Again, as I understand that Ketan sir told that we are looking at rationalization, and it looks like most of the rationalization is happening on the HPPC side on the parent basis. Is that a fair understanding?
No, this is across divisions. Textile specialty chemicals, we saw a very high rise in exports, which contributed very well. And as a company, if you can see, our exports have grown from 64 crores last year to consolidated 264 crores this year. So the exports also has shown very, very healthy growth. We have, of course, cut down on customers where we don't have margins, or products we don't have margins. But if you compare 126 crores standalone HPPC to the last year, with quarter 2 and quarter 3, we also had higher prices in FG because of higher prices of raw materials, and this would normalize at certain extent. So I think there is not too much of a fall in HPPC that way.
Fair enough. And Chariji, just to understand, when we say that we are cutting down on the sales or moderating the sales to the product or the customer, where margins are lower, can you help us understand what is causing us not to take the price hike? Because raw material inflation is across the players, right? It's not just for Rossari, and they wouldn't get the material anywhere at the historical prices. So what is such that we are not able to take the price increase and still manage to convince the customer? So what are the product category or a customer category which we are fighting to, or we are doing a moderation?
So Sanjay ji, this is Edward here. Hi.
Yeah, hi sir.
Hi. So you will understand that we have two categories of products. One is our trademark formulation black box, and the other is the ingredients. So what is happening is, with the formulation background, since the ingredients are a kind of a black box for the customer, it becomes very difficult to go to the customer with multiple price increases. So we've been increasing our prices from March, from the quarter of March this year, and it is becoming impossible to pass on price increases to customers without them knowing what are the ingredients inside. So this is a trade-off that we have to play now. Wherever it's a formulation black box, we are cautious and we don't want to reveal all the raw materials. However, wherever there are ingredient sales, like many of our peers, some of our peers, they do ingredient sales. Ingredient sales, the raw materials are open, and therefore to pass on the raw material increase in prices is a little bit easier than for the product range that we are working in. This we have experienced also with Unitop and Tristar. With Unitop and Tristar, it is easier for us to pass on the raw material price increases, whereas with specialty product range, it becomes, we have to be cautious. We have to be cautious, keeping in mind our customers as well as keeping in mind the competition.
So is it fair to assume that the private label or white label, I will call it, not private label, that white label business itself has slowed down for everybody because they don't want to increase the prices of the end product and they are also compromising on the sales, and hence we are also seeing a lower volume. Is that the case?
Sanjay, if you see our last year's HPPC sale of Q4 FY21, it was 108 crores. So compared to 108 crores, we are at 126 crores now. So we have a significant jump. If you see Rossari on a standalone basis, it has grown from 700 crores to nearly 1,050 crores. So we have a 50% growth, and which is because of abnormal, pipeline being vacant in Q2 and Q3. But 108, say 126 is already an 18% growth. So even in Q4.
That was not my question. My question was, what Edward sir told that we are not disclosing the ingredient of the white label, right? And hence the price increase becoming difficult. It's not that white label will be buying a new product from anywhere, right? Because we do end-to-end manufacturing for that. Is that the white label themselves are not willing to sell too much because they are not able to take the price hike from their customer, and hence their sale is falling, and hence we are also impacting, or they are buying that material from somebody else and supplying in the market? What is the situation?
So as I already informed you, that we are cautious both with what the customer sentiment is and how the competition is reacting. We don't want to lose business in white label because that is where the technology plays a bigger part, and therefore we have great strength in the white label business. And hence, like you said, you are very correct in saying that the customer who buys white label products from us really are unable to pass on their price increase to their customers. Not only that, but for the white label, for example, in textile, if you see the prices of cotton, they have gone through the roof. So it is becoming impossible for them to pass on the prices to the customer, and therefore we are cautious with pushing them for price increases. So it's a trade-off kind of a thing. Having said that, we have still grown from last year. So if we have lost business from what we had done last year, then your argument could be correct. But that is not the case. The case here is that we are cautious because we have to go to the customer on multiple occasions for price increase. We've done that with our ingredients that we sell, but we are cautious and we find it little more difficult to do that. And like Ketanji has already expressed, that by the end of Q2, both things will kick into place. Then the raw material situation will normalize, and therefore we may not be required to do the price increase, and we can still keep the customer happy. So it's a trade-off kind of a situation for us now.
Got it. Just a couple of more follow-up questions on that. If you can help us with what was the volume growth in the parent business for FY22? And Ketan sir told that we have been taking price hikes since March and we will continue even in the Q1. What is the quantum of price hike are we anticipating to, or we have already started the process? So what is the quantum of price hike we anticipate to take during this entire exercise?
So Sanjay, you're aware we don't give this split, but compared to FY21,
I'm just asking FY22 if you can provide that for the full year.
A full year, I think our overall volume growth is in excess of 40%.
No, this include acquisitions. No, this I'm talking without acquisitions.
No. I'm talking only about standalone.
I said we have grown 40% in volume for.
Yeah, because as I said in my opening remark, our the age became fully functional early this year or probably later because it got capitalized towards the end of FY21. So that entire capacity came on stream, and as I said, a lot of this additional capacity which came, it helped us in gaining this volume share and the revenue growth. Maybe quarter to quarter the volume growth would probably be steady, but on an annualized basis, the capacities have helped us to ramp up the revenues.
So assuming that our EBITDA per kg has fallen from X to Y, what is the amount of price hike required for us to reach that EBITDA per kg again to the FY21 level?
So, Sanjay, look at EBITDA per kg. We've not looked at it that way. Our immediate target is to come back to our EBITDA margins of 14-15%, which we are currently looking at. We are at about 11.5. We closed this year, and we are working towards that. As I said, taking some price increases, expecting some further softening in the raw material front, rationalizing our product portfolio. And I think all these should help us going forward to come back to our 15% odd margin.
Sanjay, we sell in tankers, we also sell in 1 ml sachets. To do the measure quantity, numbers or kilos is not, and it differs. Some products sell more in some quarters, so we have never been able to work out quantity-wise breakup because we have different divisions, different products, and as I said, 1 ml, 2 ml, 10 ml का comparison नहीं कर सकते हैं with a tanker sale product.
No, that's complete. Just to understand. So to reach this 14-15% EBITDA margin from where we are today, how much percentage price hike will be required?
Offhand, I cannot tell you what is the price. It's all a combination of products, and also, as I said, it's just not price hike. We are also looking at product rationalization, and we are expecting the raw material prices to, remain at the softened positions going forward. So we'll have to look at all the fronts. It's just not going to come only by price increases.
So Sanjay, we have given 2,000 crores and 250 crores as our target for this year. We are very, very well confident to achieve those numbers this year.
2,000 crore revenue and 250 crore EBITDA, right?
So that is something which we are very confident we have given in the past calls as well.
Great, sir. Just one bookkeeping question to Ketan, sir. The tax rate in Q4 was high. What should be the steady state tax rate for us, and why was the tax rate higher in the Q4?
So, Q4 tax rate on a consolidated basis was slightly higher because we had to do some tax recalculation for the two subsidiaries. That's why the rates were higher. But I think on a steady state, if you see the annualized number, it's I think about 20 to 25%. So that's what the rate should be. We are all at that 25% tax bracket.
Got it. Thank you, sir. Thank you very much, and best of luck for you to achieve the 2,000 and 250 crores in FY23.
Thank you, Sanjay.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, first question on the HPPC, the segment there. Now, as you mentioned, there are certain products with specialty ones, wherein the price hike has not been as aggressive, or let's say the multiple price hikes are not there. So, just thinking aloud. So, how are we trying to scale up that business? Because that is one sort of green part of our business. So, is there any change in strategy in terms of how you should price the contract? Maybe not entering into an annual contract, but maybe more quarterly. Or is it more like a current situation being volatile in terms of RM pricing available, and hence, we'll probably rejig the thoughts there again? Your thoughts there, please.
Anshulji, your question is very relevant. Of course, the customer knows what is going on in the marketplace, and therefore he does not expect us to take a long-term strategy or a short-term strategy. It is to take one day at a time, basically. That is our idea. But from the product front, we are looking at being more innovative, trying to help the customer to rationalize his cost of finished product by giving him innovative solutions. That is our focus, rather than getting into contracts for long term or short term. Both the strategies today don't work out for us because the situation is so volatile that even the customer is not willing to get into a contract with us, basically, because everybody expects the price to come down in the future, and if you fix the price today, in the future they might lose out. So nobody wants to do it short term or long term. But our focus is to give them innovative solutions in order that they get some idea of how to rationalize their prices, pricing strategy, especially in the HPPC. As you must have seen in my opening remark, the first was in HPPC we have been able to launch a unique novel product, which really gave them some value addition. So maybe the price of the product did not go down, but they were able to use, rationalize the quantities that they use in their formulations, and we gave them some tips for their formulations, which brought down the cost of their formulation. So that's the kind of synergy that we are working between a customer and us, so that both of us are benefited. Only price, like Ketan sir said that only price is not going to help anybody in this situation. Our R&D has been working fervently to come up with better formulations. We come up with applications with formulations which work better in application, and therefore you have to use lower quantities in the final finished product. So we are using different methods to bring down the final price of the product, so that the end customer does not suffer. So basically that is the approach. The approach here is not about price increase at all. Price increase is the easiest way out, and is also a very easy way to lose your customer or give a waiting competitor an entry into the customer. So we are using all the three different methods to get in there. R&D is working. Our sales teams are working to push products with higher margins. We are working with our raw material suppliers to get the best prices that we can, and we are also trying to get some price increase logically with the customers. So it's a 4 to 5 pronged effort that we are trying to get into, so that the customer is not dissatisfied.
Got it, sir. So probably from that perspective, if I got it right, it will take some time for the full RM inflation to be passed through, especially for the white label part of the business and the volume ramp up happening there.
So as I said, we're working on this. We are expecting that probably by Q2 we should be enough and get into our regular margin profile.
Ankurji, to add to this, when we came for the IPO in 2020, just 2 years ago, we were at 600 crore sales and 80 crores EBITDA. And at this moment, we are talking about 2,000 crore and 250 crore EBITDA. So in 3 years, we have been able to grow more than 3 times, and in 3 years, we have been able to more than even the EBITDA has grown 3 times. And we still remain debt free. So the focus is on a consolidated basis. On if you see even the Q2 AHN numbers, which were 38 crores, and now it is 25 crores in this. But if you compare with Q4 FY21, even AHN has gone from 21 crores to 25 crores. So this is something where we have on across divisions, across this on a year-on-year basis, we have grown on standalone also, but on consolidated basis we have grown much bigger now. And the best part is also the working capital cycles remain intact. We remain a debt-free company, and the working capital cycles are also intact.
Sure, Sharji. Just, another thing, on the overall volume growth front, which you mentioned 40% for the full year, we have grown on a standalone basis. So, if I got the numbers right, broadly, there is only a 15% price hike that we have in the year. Will that be a right understanding there? On the standalone basis only.
If you see the overall the annual growth that has happened in the revenue of about 55%, I would say about it would be in the ratio of 70 to 30% volume and price.
Okay. And now,
but it will be around that.
Sure. And on a Concall basis, we are guiding for 2,000 crore odd revenue, which is another, let's say, 30-35% growth over 22 days. What should be the volume growth that we are targeting here? And will HPPC be the bigger segment contributing to this growth?
Yeah, so the volume growth should be significant. One, because the subsidiaries will have the complete full year numbers. Second, we are expecting raw material supplies in the subsidiaries, the key raw material of EO to get stabilized from the second quarter. So that will help us push better capacity utilization. So the number for the volumes will definitely be much stronger going forward.
But any directional call, maybe a 20% plus will be a volume contribution. Where I'm coming from is basically, if the current business, and you mentioned we are targeting 14-15% odd EBITDA. If I do some back of the envelope working, probably we need to take another maybe minimum 10-15% price hike there itself, maybe around 20% price hike to be there. And if I take that 20% out of 33, that number comes out to be 15% volume growth. So is 15% the right number, or maybe a higher end, a higher number there will be more?
Not right, Ankur. We have at least about 15% volume growth coming next year.
Sure. And lastly, if I may, specific to Edward sir, given we highlighted many initiatives in terms of new product innovation, not only at SPPC but also on textile chemicals. What are our thoughts in terms of the growth here in textile specialty chemicals, especially from the international market and domestic, given that there were certain portfolio gaps which now are incrementally getting filled? Will it take some time, the product approval side and the revenue ramp up, and it is more FY24 rather than 23, or how should one look at that?
So Ankurji, the new product impact definitely takes some time, but these ideas have already been floated in the marketplace. For example, the silicones with low cyclic content, the sustainable dyeing programs, as well as the low temperature washing off programs. So all these have already been seeded in the marketplace. We expect very strong export growth because we are focused on export in this year as well as in the coming years. Because if you see the export share in the standalone itself has gone from 9% to 11.5%. So there you can see that even in the last quarters we had been saying that we will be focusing on export. So similarly, since the focus on export has increased and we have also increased some manpower in the export side, we are sure that there can be a 10 to 15% growth in the textile space as well.
Sure, sir. That's helpful. That's it from my side, and thank you for answering all the questions.
Thank you. Participants, you may press star and 1 to ask the question. The next question is from the line of Nitin Tiwari from Yes Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. I hope I'm audible. So while quite a few of my questions are answered, just a few clarificatory ones, if you may please. So you mentioned that we have black box products plus ingredient products in the SPPC segment. So can we have a rough percentage of what what is the percentage of black box products, and what is the revenue percentage coming from ingredients?
So Nitin, we would not like to disclose these specific numbers.
No, I'm not asking for specifics. Just rough indication should be enough.
So, would like to keep that as confidential for us.
Okay. Secondly, sir, you just mentioned you were just talking about the volume growth with the previous participants. So, just to summarize, can we have sort of an overall picture in terms of volume growth we are targeting segment-wise? So would it be right to understand that we'll have about 15% sort of volume growth in HPPC as well as in textile segment, and then so it will be 15% across segments, or how is it? If you can just give us some granular detail over there.
So I think we could average out amongst the segments. We don't give specific volume-wise numbers for the segment. But as I said, this overall our volume growth has been around the range of 40-odd%. HPPC has grown very strongly, and also in the current year, as Chari sir and Edwardji said, we our AHN business has also grown quite strongly. So that too has played a good role in the overall volume increase.
So that was for the FY22. I'm talking for the FY23. Where the guidance is for about 15% growth. Is that correct?
Specific guidance, on specific division. The overall guidance should be good enough as of now.
So overall guidance is 15%, is it?
Yeah, for us the overall guidance is 2,000 crores in the top line on the Concall.
Okay. No, I'm just trying to break that down and just trying to reconfirm the volume part and the pricing part. So, is there any thought?
I do not know that as of now.
Okay. Lastly, sir, any comments on the new product segments we were trying to explore? I'm sorry if you've already answered that and then I missed. But you were looking to foray into esters and a couple of new products. So, any updates on that front?
So I didn't understand your question, Mr. Nitin. Can you rephrase your question?
No, I was asking that any updates on the new product segments that we were looking to get into, like esters and other products. So any updates on that front?
As mentioned in my opening statement, all these new products are now at the introductory stage. So we have already introduced them. Some of them we've already introduced in this quarter. Some of them are slated to be introduced in the coming quarter. But interesting products are, the products that which will go into cellulase, regenerated cellulase as additives. Then we have the black dyeing process, which we have already applied for a patent. Then we also have the new preservative that has been developed jointly between Unitop and Tristar. That will also be one of the interesting products for the coming quarters. The most important one will be the synergy that we have between Unitop surfactants and Rossari polymers to bring in a new novel ingredient for enhanced cleaning performance, which will create an opportunity to partially replace traditional detergents in the HPPC segment. That is an important development, and we promote that product very aggressively in the market. We have got some of the customer approvals already. And another new development is the spin finish. Again, it's a synergy between Unitop and Rossari Biotech, where Unitop's surfactants and Rossari Biotech's application teams have developed the spin finishes for textiles. This is a large segment in which Rossari is not present. So I'm very sure that we will build sales in this segment as well. In the animal health and nutrition, the esters and the glycerides that we are looking at for gut health improvement to reduce antibiotics and use of artificial growth promoters, these are very exciting products. However, there will be a challenge to introduce these products in India because there is no regulation or there is no government intervention here. So we will have to create this market, and I think this would take us some time, but we'll definitely do some. We'll definitely see some pickup in this year itself. Another very important thing that Rossari has taken up because of the integration with these three companies as well as two other smaller companies is the decision to implement SAP. So we have taken the decision to implement SAP across the organizations, which is a bold step for quicker integration. And I'm sure that by the end of this year, we are going live with the SAP implementation, and definitely the operations will become more seamless. The synergies will be seen better, and because we will have more data, we will be able to present more clearly or in a clearer way to you in the future. It's a big investment. I think Mr. Chari can tell you what is the cost of that investment, or Mr. Ketan can tell you what is the cost of that investment,
Yeah, so the overall SAP across the group will cost us about 3.5 crores, which will include not only the SAP software but licenses, a lot of hardware and the implementation cost, the cost of the consultants, etc. So that's what we are aiming at. Our target is to get this operational by the end of the current year.
Great, sir. Thanks for the answers. Just a last one, if I may. So there was a constraint on the availability of ethylene oxide. So I suppose that was supposed to get resolved by the 1Q of this year. So I suppose you just mentioned that it will now be resolved by 2Q. So is there a delay in that availability? Can you throw some light on that, please?
Reliance has still not confirmed for June. So in all probability, we will see enhanced EO availability from July onwards. This is subject to confirmation from Reliance. But with the expansion in the Dahej, we are hopeful that from July onwards we should get a higher EO allocation.
Right. Thank you so much for all the answers. I'll get back to you.
Welcome, Vinji. Welcome.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from Ashish from Invesco Investment Advisors. Please go ahead.
Yeah, I have just one question on the cash flow statement that has been given on the slide 13 of the presentation. So there's an item which says net gain or loss arising on derivative instruments measured at fair value through profit or loss. That's a big item, 192 crores. So just wanted to know what's the charge on the cash flows there. Hello. Hello.
Just give us a second. We'll just go through that.
Yeah.
Actually, I think there is a typo in the presentation. That line should actually have one below the operating profit before working capital. That should have been 192.5. Typo.
Sure. No problem. Yeah. Thank you so much.
But you can still from the goodwill.
So the operating cash flow generated is 30 crores. That's the last number is correct. 29.4.
Yeah.
Okay.
Some line has got.
Yeah, it's a misprint. Yeah.
So we'll correct that. Yeah. Thanks.
Sure. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. As there are no further questions, I now hand the conference over to the management for closing comments.
So thank you everyone for taking part in our investor call. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call. Good evening, everyone.
Thank you very much. On behalf of Rossari Biotech Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.